Hello, everyone. Dr. Kenyon Meadows here, the Invest Doc. Thanks for taking the time to watch our video. If you could take a moment to like, share, and subscribe, we would really appreciate it. Here on the Invest Doc channel, we are all about income investment education. And today we're talking about one of my favorite strategies that can add a significant income component to some stocks that you may be holding, and it's called the covered call strategy. Now, if you haven't had a chance to join our email list, you can do so by clicking on the link down below in the video. That will also get you a copy of my ebook, Buy Your First Rental, talking about why I think that income producing cash flowing rental property, direct ownership of it, is the best asset class that I have found, with an unbeatable combination of cash flow, tax benefits, appreciation, and the ability to use leverage. So we would really want for you to get that. Okay, now back to the topic at hand. What is covered calls? What are stock options? Okay, our friends over at Investopedia define a stock option as something that gives an investor the right, but not the obligation, to buy or sell a stock at an agreed upon price and date. And there are two types of options: puts, which is a bet that the stock will fall in price, and calls, which is a bet that the stock will rise. And where these names derive from is, okay, if a stock goes down in price, the person who buys the put contract is buying the ability to put those depreciated shares onto you, okay? And the call buyer is buying the right to call away your appreciated shares if they go up in value, okay? So that's where those names come from. Now, and one options contract, be it a put or a call, represents 100 shares of the underlying stock. So you cannot participate and do stock options, buying and selling of them, unless you own at least 100 shares of the underlying security. So that's a key thing to know. Okay. Now, we are focusing in on this bottom left part of the quadrant here, in terms of selling call options. Okay. And they also sometimes call it writing call options. So what we are doing is we are selling off our call options, which is going to bring in some immediate income. Okay. And the idea is, can we keep selling these call options against shares that we hold, and the shares that we hold continuously don't go up to that appreciated price level at which they'll be called away? That's really the name of the game. You're trying to pick a level. It's called a strike price. Okay, that price above where the shares are trading at. You're trying to pick a level where you don't think the shares will go, and in exchange for that, you're taking in some immediate income. So there's a lot that goes into it in terms of what's an appropriate style of stock or type of stock to do covered calls on? What's an appropriate length of time to be to have that obligation over the stock that it might get called away? And then what's an attractive amount of money that you would receive as that option premium, as we call it, to entice you to want to do it? And that's where a lot of the study and the nuance and comes in, so that you can do this strategy optimally. Okay. And just so you know, this type of strategy, covered calls, and something called cash secured puts on the other side of it, these are actually considered conservative option strategies that even somebody like a Warren Buffett, who we think of as Mr. Buy and Hold Forever, well, Warren Buffett will oftentimes sell put options, which again are bets that stock will go down a certain amount, and he uses that as a way to get into a position that he plans on holding for a long time at a very attractive price. Very famously, back in believe the late 80s, when he established his humongous Coca-Cola position, he sold millions of dollars worth of put options. And I think Coke at the time was trading at $39 and he wanted to get in at $35. And so he sold a lot of these put options and basically waited until the stock came down before he entered his position that he planned on holding for a long period of time. So just to let you know, some of the most sophisticated investors will use options as well. So what's the covered call checklist? And this is my checklist that I use when trying to select an appropriate candidate. Okay. So number one, you've got to own 100 shares of the stock. Number two, you want to do this on what are called low beta stocks. What is beta? Well, basically, beta is a number that tells you how correlated is a particular stock versus the rest of the stock market. And you can think of it this way. If the stock market goes up 20% in a year, but an individual stock only goes up 10% that year, that would be called a low beta stock, and that it only went up 50% compared to the general broader market. And again, because we are doing the covered call where we're hedging or trying to not have our shares appreciate too much so they get called away, we actually want to do this on low beta stocks. Now, as far as duration goes, call options, put options, they're ones that are out there that are as short as a week in duration. And then there's ones that are very long in duration, a year or two. Actually, you can go out that long. Most of the people that I have learned from and advocate this approach, they do a 1 month duration in terms of the call option itself. Now, what percent likelihood do you want to choose that the stock will not rise to? And so people choose strike prices. Okay, and again, the strike price is that price above where the shares are currently trading. They pick a level that basically gives them about a 70% chance or greater sometimes that the stock won't appreciate there. So therefore, they'll be able to keep the option premium and keep their shares. And the other key thing is you don't want to have the call obligation stretching through an earnings report, because when earnings reports happen, stocks that normally don't move a whole lot can sometimes go up significantly. And so people generally do not advocate that you have covered calls on during earnings. Okay. So let's talk about a concrete example here from my portfolio. Coca-Cola. Okay. This is a stock that I have written a number of covered calls on. First thing I would draw your attention to is the return for Coca-Cola over the past year. It's gone up $4.75, which translates to a 9.5% return over the past year. Certainly not bad. And Coca-Cola also pays a dividend of 3.29%. Now, if we look at the broader S&P, we see that it is up year to date close to 17%. So again, Coke's gone up about 55, 60% compared to the broader market. And Coca-Cola represents the ideal candidate, in my view, for covered call writing. These are typically your larger, well-established companies. They appreciate slowly, or basically trade in a range, if you will, and their shares are not generally subject to big swings, even with earnings a lot of times, honestly. So you certainly wouldn't want to do this kind of strategy on a newly minted IPO stock where it could swing wildly to the upside or downside. And you also generally wouldn't want to do this on companies that have exhibited a consistent pattern of above market growth, things like an Amazon or a Facebook that you'd actually would anticipate would grow faster than the market. You would never want to limit your upside and have your shares called away by putting call options on them. You'd want to just hold that stock and participate in all of that accelerated upside. So there definitely is an art to picking out good companies. Now, this slide's a little busy, but I want to put some numbers on this so I can give you a nice concrete example of how this works. This is an options chain, and you can find this on any broker out there. This just happens to be the Robinhood platform, which is just one of the platforms that I use. So I want to draw your attention down here in green. This is the current share price of Coca-Cola, $54.32. And I'm looking at the options that expire about a month away in January 10th, 2020. Okay. Now, I'm looking at the strike prices, and these are those prices above the current price. And I'm looking at the $55 strike price, which they're telling me has a 71.38% chance of profit. That's the likelihood that Coca-Cola will not be at or above $55 by January 10th. Okay. And the amount that you would be paid for that is 56 cents per share. And you've got to remember that an options contract is on 100 shares. So that's $56. So that $56 versus the cost to secure 100 shares, $5,432, that represents a little bit over a 1% income return over a period of a month. And that's generally what I strive to get ideally, 1% a month. Sometimes the option prices are not that rich, as it were, and that is largely a reflection of the overall market volatility and also the volatility of that individual stock that you are selecting. Okay. So let's look at my history with Coca-Cola here. So at the very bottom here, on September 20th, I purchased enough shares to get up to the 100 share threshold. I did have some shares prior to that as I was slowly building my position. And then on September 20th, I went all in, bought 48 shares, which got me up to 100 shares. And you can see later that same day, I sold a $55 call option that was expiring about a month later. So from September 20th, I sold a call that was going to expire on October 18th, and I immediately took in $78. Okay. Now I will highlight that call expired worthless on October 18th. So I kept the full amount of that premium, and I was actually able to do this a number of other times here in the green boxes. I sold another call for $28 here, and then several days later, I was able to sell another for $52. Okay. Now I will highlight in yellow there the $17 dividend that I received at that time too. So that was another additional income source that you're going to get just from buying and holding the shares anyway. Okay. Now we keep fast forwarding here. We're into November and early December, and I would highlight again, on December 2nd, I was able to sell another call. Okay. And then I am coming up in mid-December. I will be getting another dividend that's reflective of holding 100 shares of the stock now of $40. Okay. So let's compare the buy and hold approach where I would just receive my dividends versus the multiple calls I was able to sell against my Coca-Cola holdings. Okay. So I got $17 and then I got another $40 coming up. And so that would be $57 in dividends over the closing price of Coke on the day I made this video. It was $54.47. So again, times 100 gives us $5,447. And so when you divide that out, that basically gives you a 1% return in 4 months, which is totally in keeping with the 3.2% dividend that Coke pays. Okay. There's nothing wrong with that, of course, But then contrast that to the option selling approach, where again, because my shares never crossed that strike price threshold and got called away, I was been able to keep my shares, and I was able to keep the options premium. So that turned out to be $249. Okay. And when you divide that out, that turns into a 4.5% return in 4 months. And, extrapolating that out, now we're getting at, what is that? Let's see, over a 13% return. So that just illustrates to you. Now, this was totally ideal, okay? And there are some things that we could talk about in terms of when things don't go as planned, and you want to basically buy back that call option if your shares do appreciate above the strike price, and what to do if your shares drop and that kind of thing. So this has been ideal thus far, but I will tell you that most months with the right kind of stock selected, this is a very repeatable process here. Okay. And you can also see how doing this constantly over time, some people look at it as an income generation strategy, and others view it as a cost reduction strategy, in that if you do this consistently over time, the extra income you receive from the options premium, it will significantly lower your cost basis for the stock. And I do know folks that have done this strategy for years, and essentially they have their shares now paid for with this conservative option selling approach. Now, there's a lot that's in this short video here, and of course, you are not going to be comfortable doing this strategy after just this. But I do want to point out some resources on the web that I found useful to get me comfortable with this approach. There's a site called the Blue Collar Investor, run by Alan Ellman. I got to give him a shout out. All he does is talk about covered calls, and he's got a very extensive blog. He's got a good YouTube channel. He's got courses, and so that's a very, very good resource there. And if you stick with us here, we will continue to show you trades from my account, and we will walk through some of the subtleties and the nuances and whatnot. I know you're going to have questions. So again, please sign up for our newsletter down below, join our email list, get the ebook. And if you've got any particular stock that you want to ask about, is it a good covered call strategy, or some of you all out there doing some of these strategies, I would love to hear that. Okay. So again, please like and share the video, and we will see you next time. Thanks.